Does anyone else feel like every time you fix one part of your budget, another part sets itself on fire? Rent goes up? Fine, tighten the belt. Groceries go up? Sure, buy the off-brand ramen that tastes like salted of despair. Because here's the part nobody wants to admit. You're not behind because you're irresponsible. You're behind because the entire financial system quietly moved the goalposts while you weren't looking. They didn't announce it. They didn't warn you. They just shifted everything 10 yards farther and expected you to keep sprinting. If you bought a car before 2020, congratulations. You were playing personal finance on easy mode. You didn't know it then, of course. You were probably still complaining about interest rates being a little high. Oh, sweet summer child, if only you knew what was coming. Those rules? Gone. Dead. Buried in the financial graveyard next to cheap rent and affordable healthcare. Fast forward to today, people are signing car loan agreements with payments that look suspiciously like rent. $700, $900, $1,200 a month. For a vehicle that depreciates faster than a bag of salad in a warm car. And the craziest part is, these aren't sports cars or luxury imports. These are everyday trucks and SUVs sitting in driveways of people who are eating cereal for dinner because it's all they can afford after filling up the tank. So, what exactly happened? Why is a vehicle, something that literally loses value the moment you look at it too hard, now one of the biggest financial traps in America? Well, I crunched the numbers so you don't have to. And I've got bad news. Let's start by killing a myth that refuses to die. If you make good money, you can afford a big car payment. No, absolutely not. That logic aged worse than a 2011 Kia with no oil changes and a gallon of expired gas in the tank. Because here's the part nobody wants to admit. There's an entire class of people economists call Henrys. High earners, not rich yet. These are folks making 80, 100, even 180 grand a year, who are still one layoff, one medical bill, or one transmission failure away from total financial disaster. Because income is not wealth. It never has been. Here's the truly horrifying part. Someone making 6 figures today often has less disposable income than someone making 70 grand 10 or 15 years ago. Why? Because inflation took its cut. Taxes took their cut. Childcare took another cut. Housing took a massive cut. And then car loans came in, reached into your wallet, grabbed whatever was left, and politely asked if you had any snacks. And I'm not exaggerating. The average new car payment is now over $700 a month. For trucks and SUVs, $900 to $1,200 is the new normal. And the most dangerous part is exactly that. It's normal now. These numbers would have caused riots in 2015. People would have been flipping cars in dealership parking lots from sheer financial rage. But today, people look at those numbers and shrug. Well, that's just how it is. No! That's how they convinced you it has to be. Because the auto industry didn't just raise prices. They built a psychological trap around those prices. And most people walk into it with the same awareness as a raccoon approaching a glowing dumpster. So let's break this down with real numbers. Half of Americans, the bottom 50%, earn around $40,000 to $50,000 a year. For them, a $900 monthly payment isn't just too high. It's mathematically impossible unless they sacrifice essentials. These are the people taking 7- and 8-year loans just to make it work. They roll negative equity into new loans because they can't afford to pay the difference. They use credit cards to cover insurance, maintenance, gas, and repairs. They pray the check engine light is bluffing. One blown transmission, and the financial Jenga tower collapses instantly. Then there's the middle group, the 60 to 120,000 earners. On paper, these people look comfortable, but in reality, they're the ones being squeezed the hardest. These are the Henrys, high earners, not rich yet. Too much income to qualify for help, too little margin to actually feel secure. Car companies love this group. They're perfect targets. The dealership knows that someone earning 90 grand a year feels like they should be able to drive something nice. So they push 7-year loans, 0% APR promotions that hide inflated prices, upgrade every 3-year sales cycles, and dealership add-ons priced like museum artifacts. A buyer walks in thinking, I can afford a $40,000 car. The dealer smiles and says, amazing! Let me show you this $68,000 truck, only $900 a month for 8 years. And because the monthly payment looks manageable, they sign. The emotional part of the brain wins. And wealth doesn't grow in this group, survival does. Meanwhile, the top 10%, they're chilling. They don't stress about car payments because they rarely have them. They pay cash. They buy used after the first owner eats the massive depreciation. They keep vehicles for 10 or 12 years. They treat cars as tools, not identity accessories. And then there's the top 1%, the people playing a version of the financial game the rest of us don't even have access to. They don't buy cars. They buy time and tax advantages. They lease high-end vehicles through business entities. They write them off. They aren't emotional purchases. They're line items. To them, your dream truck is their office stapler. But here's the part that no spreadsheet, chart, or interest rate calculator can explain. Car payments are not about money. They're about identity. Auto marketing spent billions convincing you that your vehicle is a personality upgrade. You're not buying a truck. You're buying rugged masculinity. You're not buying an SUV. You're buying the idea of being a reliable parent. You're not buying a luxury car. You're buying the illusion of having made it. It's not transportation. It's a costume. And that's why people will cut groceries before cutting a car payment. They'll move into a smaller apartment to keep the truck. They'll feel genuine shame admitting they downgraded to a smaller vehicle. They defend the $1,200 payment like it's a beloved family member who just needs to be understood. People don't drive cars, they drive self-esteem. And nobody understands this better than the auto industry. But here's the twist. You don't actually hate your car payment. You hate that it owns you. Freedom, not luxury, is the real flex. Having a paid-off used car isn't being cheap. It's being untouchable. It means if your boss loses it one morning, you can walk. If the economy tanks, you're still safe. If an unexpected bill hits, you're not instantly ruined. You're not trading your dignity for heated seats and a panoramic sunroof. Rich isn't the car. Rich is the breathing room. And the good news is, you don't have to beat the entire financial system. You just have to stop playing the game they designed for you. So let's talk solutions. If you're tight month to month, first, stop rolling negative equity into new loans. That's quicksand, disguised as progress. Pause. Reset. Second, buy a car in cash under $7,000 to $10,000. It won't impress anyone, but it will save you. Third, take that old car payment money and put it in savings. In 6 months, you'll breathe like you just came up for air. If you're stable but stressed, aim for a car worth 10 to 15% of your income. Refinance your loan shorter, not longer. Escape sooner, not slower. And create a freedom fund. 3 to 6 months of expenses changes how you sleep at night. If you're already ahead and want to build real wealth, never finance new. Let someone else take the massive depreciation punch to the face. Buy vehicles 3 to 5 years old and treat cars like phones. Replace them when they're failing, not when you're bored. And now I want to hear from you. What's the biggest car payment you've ever taken on? And was it worth it? Because you're not the only one who's walked into this trap. And if this video helped you see the game a little more clearly, hit that like button so more people can escape the treadmill.